Hello, class. My name is Zaki Dejani, and I'll be walking you through my presentation. My presentation is going to be on the Pfizer company. That was the group that I was assigned. So without further ado, let's begin. All right. So Pfizer is one of the leaders in the biotechnology as well as the pharmaceutical industry. They're second to only Johnson and Johnson. They're the one of the largest in the world. They have many achievements under their belt, such as the mass production or the help of mass producing penicillin, which hugely and greatly helped many of the frontline veterans during World War II, um, which saved many countless lives that would have died otherwise just due to lack of the proper medication. Pfizer started off with two cousins, one named Charles Pfizer, one named Charles Earhart. Um, they saw explosive growth after they've created their company, especially during World War, excuse me, so the Civil War. They saw their revenues nearly double, which is very exciting if you're the owner. But yeah, they're also credited with some of the largest manufactured and produced medications such as Zoloft, penicillin, and Viagra, which is an erectile dysfunction medication, as well as many others. All right. Pfizer's mission statement is to expand, obviously, but the way they intend to expand is by capturing emerging markets as well as expanding healthcare here as well as abroad. Okay. Um, I've also listed some of the leadership below. So you got I had put down the CEO, the vice president, the CFO, and the chief science officer, as well as some of the locations, which include some areas in Massachusetts, some areas in Colorado, California, New York, Missouri, and one in the UK. All right, so for the liquidity ratios, this is going to be the first topic in the second part, which is the financial ratios. When it comes to liquidity, Pfizer didn't do as well as I would have hoped. Unfortunately, they performed worse than they did in 2018. You can see that through the current ratio as well as the quick ratio and the cash ratio. The most staggering, I would say, are going to be the current ratio and the quick ratio, where we see about 40 to 50% decrease, which is quite concerning. That being said, when we look at the numbers that led to these ratios, what it seems like is a lot of their current assets were no longer available, maybe because they invested into something or they sold them for some sort of investment. It looks like they're also higher debt, which that's the reason why it contributed to such a large movement in the ratio. When we take a look at the leverage ratios as well, we don't see too much performance increase on that one either. Unfortunately, the total debt ratio and debt equity ratio and equity multiplier all increased when lower is better. And that's pretty alarming. However, it wasn't by too much, so it's not too significant, like seeing the 40 to 50% movements in the liquidity ratios. However, times the interest earned ratio increased by 6%, which is a good thing. Basically, what that means is that external people, companies that owe us, pay us more efficiently or faster. But yeah, and then also the cash coverage ratio decreased, which is a negative indicator. Okay, so next. Alrighty, so for turnover ratios, that didn't perform much better either, unfortunately. We see a decrease of 18% there, which you can see in the relative amount of days that it takes for them to get rid of their inventory. About 244 was 2018, and now it takes about 296. And then you can also see that it takes they're less efficient in their ability to receive their debts. So it's definitely interesting. As you can see here, that correlates to about 55 days to 62 from 2018 to 2019, which is definitely not a good thing. Okay. Where we see actual growth is is in profitability. We see a substantial increase in the profit margin as well as the return on assets, and arguably one of the most important, return on equity. Okay. What this is telling me thus far with these ratios is I'm seeing that there's a lot of short-term gain. Long-term, a little bit more questionable. They're less liquid and they're more leveraged. So they're obviously investing into something. The return on that investment, that's what I would want to analyze a little bit further, see what that money is going into, and how they intend to turn that into a profit for shareholders. Okay. And then when we look at the market value ratios, also we see some positive performance. A lot of it's positive. As you can see, is the earnings per share is increased by 53% from 1.87 to 2.87, which is very good, very good. Okay. All right, and then the next part's going to be the cost of capital, or cost of equity, excuse me. We're going to be using the capital asset pricing model, which is CAPM. As you can see here, I wanted to include a formula, that way I can walk you through my work as well as my work on the left. So here, RF stands for risk-free rate. The beta is the covariance between the return on the equity as well as the return on the market, divided by the variance of the return on the market. That's beta right here. And then we have the premium, the market risk premium right here. And that's going to be the return on the market minus the risk-free rate. And then over here, you could see my work where I used 2% for the risk-free rate and 8% for the average return on the market. And then this is what I received right here. Okay. And then I also did it in a different way. I used the dividend growth model, and then I also wanted to include some sort of work as well as my work, so you can see how I got to my conclusions. I used Excel. So the way, just so I can simplify it a little bit, these are added from quarters to the annual dividend right here, and then we check the growth from 2015 to 2016. It grew by that much, then it grew by that much, that much. These are all percents. We average the percentage, and that's going to be that growth rate right there. And then D1, according to this calculation, is D0 times 1 plus G right here. So right here, there we go. All right. So also I took the liberty of also doing some valuations based on the information that I gathered. So this is assuming that the dividend will not grow and it will remain the same forever. Based on the CAPM expected rate of return on equity, I got a $23.39 per share and then $12.83 per share using the dividend growth model. And then here I also used the constant growth dividend formula, and I did the different rates right here. So okay. And then over here I did the two-stage growth model. This is quite simplified. It took a lot more work, but a lot of it was done through Excel. So I also want to take the liberty of putting the formula here so I can explain and walk you through it. D1 again is the first dividend, not the dividend initial. So the first year dividend, excuse me. And then over here is going to be what you have to do to get the second rate, which is I did 3% first, then 4% after. All right, so conclusion time. Pfizer remains the top of their their industry. There's no doubt about that. They remain flat-footed on the very top, alongside some of the giants such as Johnson and Johnson. That being said, when looking at their financial ratios, it was quite interesting to see such mixed results. The significant increase in debt, the increase in leverage, as well as the decrease in liquidity. Very concerning stuff. However, when looking at the profit margin and the return on assets and return on equity, we see an increase, and a large one at that. So what this is telling me is this is largely short term, possibly even leveraged using debt. Meaning, what I mean by that, obviously it's leveraged, but what I mean by that is the gains might be exaggerated. Okay. So for me, I would have to ask a couple more questions for me to invest. Some of those questions would be, where is that money going? What is being invested? What kind of return on investment are they expecting? And what does that translate to the shareholders? When they say expanding healthcare, and how do they intend to do that? Those kinds of questions would be the questions that I'd be asking. Hindsight 2020, would I invest? Maybe if I had known before the pandemic, and even then, what scares me about the situation that they're in. I know that they're pretty secure because the governments of many countries are going to keep purchasing, whether that's the United States or Israel or whatever. However, I just feel like that's going to take away from a lot of the research and development from other areas, and this is going to be their main focus. And I don't know how that's going to work out for the medium to longer term. So that's something that I would take into consideration. I'd be very cautious if I were you. Alrighty, thank you so much, class, and have a wonderful day.